Hi, I'm Max Keiser, and this is the Keiser Report. Markets, finance, scandal. Yes, scandal. Speaking of scandal, how about Barack Obama? Listen to this. Barack Obama does not begrudge the bonuses for savvy Lloyd Blankfein and Jamie Dimon over there at Goldman Sachs and J.P. Morgan. It goes on to say here that President Barack Obama said he doesn't begrudge the $17 million bonus awarded to J.P. Morgan Chase and Company Chief Executive Officer Jamie Dimon or the $9 million issued to Goldman Sachs Group Inc. Lloyd Blankfein, noting that some athletes take home more pay. He's equating the banksters to athletes. Barack Obama, have you lost your mind? Let me explain something to you. This is what Goldman Sachs does, okay? This is toilet paper. This is what J.P. Morgan does. This is toilet paper. All they do is they take toilet paper and they write $1 billion on the toilet paper, and then they give it to each other for a fee, and then J.P. Morgan will write, oh, here's $1 billion on a piece of toilet paper, and they give it back to Goldman Sachs for a fee. And there's collusion, because the rating agencies rate this toilet paper AAA, but there's no value here. That's not the same as a star athlete. These are crooks. These are shysters. These are financial terrorists. And you're letting them totally destroy the American economy, Barack Obama. Were you dropped on your head as a kid? Are you freaking stupid? I am totally ashamed of this president. I had no idea when he came into office that he was going to prove to be the ultimate moron. He doesn't even understand that this is all the Federal Reserve Bank in Washington sits on $5 trillion ostensibly of toilet paper. That's why they don't want to audit the Fed, because it's worthless. Beep. Look, China keeps threatening to sell the U.S. dollar. Okay, China, listen to me. As an American, I'm begging you, perform financial euthanasia on America. Put it out of its misery. Stop talking and start selling. All right, let's get the other headlines of today going on in the big, bad financial scandal marketplace. Stacy Herbert.
Max, it's good to be here. You brought up Goldman Sachs in your opening monologue there. Well, they're in the headlines, too, because, you know, this giant Greek crisis with the Greek debt and all the Europeans and everybody having to bail out the country. Well, Goldman caught using European loophole to help massively understate Greek deficit, and how Goldman Sachs helped Greece to mask its true debt. Now, this is a bit complicated, so I'm going to start here.
Ponzi schemes usually are. Please continue.
Well, yes, exactly. The deal involved so-called cross-currency swaps, in which government debt issued in dollars and yen was swapped for euro debt for a certain period to be exchanged back into the original currencies at a later date. Now, this was a deal struck between the Greek government and Goldman Sachs in 2002, and it helped the Greek government to mask the true extent of its deficit in order to help it avoid, helped it circumvent the EU Maastricht deficit rules. Now, apparently, in the Greek case, the U.S. bankers, Goldman Sachs, devised a special kind of swap, according to Der Spiegel, with fictional exchange rates, so that this enabled the Greek government to receive a far higher sum than the actual euro market value of the $10 billion or yen. In that way, Goldman Sachs secretly arranged additional credit of up to $1 billion for the Greeks.
Fictional exchange rate is the same as arbitrary exchange rate. Here's what I have to say about Goldman Sachs. They're obviously a bunch of witches and warlocks down there at 85 Broad Street. If you're looking for a place to get interested, by the way, y'all looking for possible, activist campaigns. 85 Broad Street, Goldman Sachs. And they're obviously a bunch of witches and warlocks. And what I think they should do is they should actually give Lloyd Blankfein some toilet paper. And if he can't actually turn it into $1 billion on the spot, they should tie his ankles with that big brass bull there in the middle of Wall Street and throw him into the East River. If he floats, then he's obviously a witch and he should be executed. If he sinks, then who cares?
But the thing I want to point out is that for the last few weeks, Europe has just been torn apart. The euro has been so volatile. All the credit markets have been so volatile around this constantly emerging hidden debt. You see so many headlines about Greece didn't know that they had so many debts. There's 40 billion surprised hidden debt found. They revised up their budget deficit for 2009 from 12.2% to 16% overnight. So was Goldman Sachs uniquely positioned as the creator of these fictional exchange rate swaps to have positioned themselves? And was this a situation that will emerge in a few years' time, that very much like the subprime market? Goldman Sachs helped create many of the collateralized debt obligations on subprime mortgages in America and uniquely profited from it.
Yeah, they committed fraud. It's like baseball players taking steroids.
Well, this is, their involvement in this situation in Greece suggests that they could have another bumper profit year in 2010.
Oh, they'll get huge Christmas bonuses again this year for their fraud, because a moral hazard in America, and Obama's America, means more Christmas bonus.
So I sent out a message to the viewers of this show, and I asked them what they thought of bailing out Greece. Should Greece be bailed out? And here's what we got back from German viewers. We got a comment from Stanley in Germany. He says, "I am not going to bail out Greece with my tax money. Maybe Greek government can make public offers for data CDs for rich Greeks hiding their wealth overseas. That would do the job." Now, this was an issue that was also brought up by Greek union workers on strike in Athens, who said, that they're being penalized by the austerity measures, but also by the increases in taxes, whereas normal people have to pay taxes. The rich don't have to because they just hide it in Switzerland or Liechtenstein.
Yeah, well, it's savers versus speculators. So if you're not a speculator like Goldman, you get penalized because you're trying to save and work.
We got another response from Phil from Germany, responded by sending a headline which reads, "German company will make biggest gold coin ever, weighing 3,333 ounces. This is called the Global Liberty, and it has a fineness of 99.99%, weighs 103.6 kilos, and costs 2.29 million euros.
Soon to be costing 5 to 8 million euros.
Well, exactly, but also with the whole emerging sovereign debt crises, where did governments have to turn to pay off the debts that they've incurred to bail out the bankers, the speculator class? They turn to the citizens who are stuck in the countries and aren't allowed to move across borders freely.
No.
So it's a good way to, if you have 2.29 million euros and you don't want it taken by your government to bail out bankers, it's a good way to, it's a big coin, perhaps, but...
Yeah, I mean, if you can't afford the big one there, get the small ones. I mean, if you want to save yourself from extinction, financial extinction from the Goldman banksters, you need to buy gold bullion. What else you got there?
Well, I have another epic savers versus speculators battle.
Epic?
This is the epic one of all time, and that's China PLA officers urge economic punch against the United States.
Talk to me.
Senior Chinese military officials in the People's Liberation Army are urging their government to sell U.S. Treasury bonds as payback for Barack Obama selling weapons to Taiwan.
Do it, China, do it!
Now, the actual quote from this article is, "We could sanction them," meaning the United States, "using economic means such as dumping some U.S. government bonds."
China, you're holding $1 trillion worth of toilet paper. You're holding $1 trillion in toilet paper, China. Act now.
Well, there is another headline that goes with this, and China dumps U.S. backs and corporates. This means that the Chinese government has apparently ordered all commercial banks and their own asset managers to dump all U.S. assets that are not government-backed in the United States.
Right.
Now, there's only speculation at this point whether or not it has to do with this, the PLA officer saying we should dump U.S. Treasury bonds, or if it's just fear of this contagion that is spreading around the world with this next leg of the global financial crisis.
Well, it's a new Cold War with the U.S. and China. They're at each other's throat now.
Exactly, but the question is, if this is a savers versus speculators battle, the one thing that you see over and over in the last few years is that the speculators are the ones that engineered this post-1971 fiat currency system.
Well, Stacy Herbert, let me explain something to you. It's called the Martindale system for betting. If you go to the roulette wheel and you bet red, and you're a loser, you double your bet on red again. And if you lose, you double your bet on red again. Eventually, you win. If you have unlimited availability of virtually zero-cost debt or credit, eventually you're going to win. Goldman and J.P. Morgan, they use the Martindale system of betting on the global macro scenario. They keep making bets, they keep losing, but the governments keep giving them more free money to make more bets. But eventually, China is going to realize that in order to get paid back on this trillion in Martindale betting-backed Ponzi toilet paper nonsense, they're going to have to continue to buy gold bullion, and they're going to have to commit euthanasia, financial euthanasia on America. And as an American, I'm begging China, please put us out of our misery. Just dump the dollar and let's get on with the world economy 2.0. Because this is ridiculous. Barack Obama, has tuna fish for brains if he thinks that, that Jamie Dimon works for a living and just doesn't sell fraudulent pieces of paper all day long.
Well, that brings me back to Goldman Sachs and this in the China equation, because they are the biggest investment bank involved with China. And remember, they had the massive IPO, the ICBC Bank, where they made over $1 billion on that deal. So the fact that they were involved in there, they're so heavily involved in China. You have to look at the Greek situation, and did they sell them fictional exchange rates? Did they sell them fictional U.S. Treasury bonds? Who knows? I'm sure Goldman knows, though, and I'm sure they'll profit heavily from it.
Well, what we're finding out in Greece, and we're finding out on these banks all over the world, is that they have yet disclosed hundreds of billions and trillions of bad debts. People thought that after the first wave, starting in 2007, then you had the 2008 super debt disclosure, and you had the crisis on Wall Street, and you had Hank Paulson extorting $700 billion from Congress. They thought this was the big, mother of all debt disclosures. That was nothing. That was just the beginning now. Now we're going to get into the quadrillion-dollar debt disclosure. We're talking about $1 quadrillion in bad debts, which is 1,000 trillion, yet to be disclosed. So Greece and these other countries are just now coming to the table and saying, oh, by the way, we have another 40 billion, another 500 billion, another trillion in bad debts. Goldman and J.P. Morgan alone are sitting on another probably 2 to 3 trillion in bad debts. J.P. Morgan is got probably, according to some estimates, close to 50 trillion in bad debts. That's 4 times bigger than the entire GDP of America on J.P. Morgan's books, being hidden in the shadow economy, in the dark pools, in the parallel financial universe of bad debts. And these are going bad because the bond market basically hit a wall starting in 2007. There's no more rally. What else you got?
I've got a quick headline that is just a victory for the savers, and this is New Mexico House votes to move states' money. So in a 65-0 vote, the New Mexico House has voted to take their $1.3 billion out of Bank of America and put it into a community bank.
What state?
New Mexico.
They're all terrorists. Okay, that's going to do it for this portion of the Keiser Report. Don't go away. Coming back right after this. All right, welcome back to the Keiser Report. There's a global conflict that not a lot of people are talking about. It's savers versus speculators. That's right. The people who are saving money and putting money in the bank, they're the ones who are subsidizing all the speculators in places like Wall Street and London and around the world. And the savers are being penalized, and the speculators are being bailed out every time they make a mistake. Now, we've got Reverend John Strain with us right now. He started a campaign in the UK. Welcome to the show, Reverend John Strain.
Thank you very much, Max.
Reverend John Strain, you have launched a new campaign, Save Our Savers. What is your mission and why now?
SaveOurSavers.co.uk is a mission to halt the neglect and abuse of savers, which has been going on now for almost a generation. What is our mission? Our mission is to remind policymakers that the 26 million savers in the UK are going to become an action force. They're going to move away from being a silent majority, and they're going to insist upon better rewards for savers, is number one. Two, a rebuilding of the pension schemes, which are in tatters in the UK. Thirdly, to bring policymakers to understand the very harmful effect that inflation is having on savers. Max, for almost a generation, prudent savers have been neglected, and as you indicated, speculators, gamblers and bankers have all been nurtured and looked after and cared for. Now, whoever was at fault in this traumatic economic crisis, it was not the fault of prudent savers.
Right. I don't think a lot of people realize that the $140 billion in bonus money that got paid out on Wall Street this year, if you work out the links between the bonuses, the bailouts, the risks that were being taken, the artificially low interest rates, and the coercion that the Wall Street bankers placed on the government to bail them out, and the placement of pension accounts that are now in the domain of bankers on Wall Street in the City of London. A lot of people don't understand that that $140 billion bonus payment on Wall Street this year came right out of pension accounts, came right out of savers' pocketbooks. And it's really, what we like to talk about on this show is that the speculators really have a predatory relationship with the savers. It's not by accident that they're stealing the savers' money. They're doing this by design as part of this financial conflict. Now, you say that governments have attacked the interests of responsible savers. So can you go into that a little bit?
We do feel that governments have neglected savers terribly, and an important responsibility for the very low interest rates that we've had now for 10 years or so. They were not the doing of savers. They were above all the responsibility of governments, of central banks. And it's the policymakers who, above all, we want to draw attention to. Interest rates were too low for too long, and the people who suffered from that were prudent savers, and it's the prudent savers now who are being ignored in the way forward. So we want to bring a halt to that. We want to keep our focus firmly on savers, particularly those savers who are struggling to build up something for the future. We're not here to be great experts on exactly how the international banking system should be reformed. What we want to do is to keep savers in the forefront of policymakers' minds at the moment. Saving for our futures and for the futures of our families and the communities that we care about is a vital component of the common good that we expect governments to encourage and protect. And Max, they've neglected it.
The basic idea of savings, of course, goes against the orthodoxy of, let's say, a John Maynard Keynes, who talked about the paradox of thrift, and talking about while savings is actually a detriment to the economy as a whole. But what we've seen is that that would only be true if the price mechanism to derive interest rates was set by the market itself and you had a free capitalist market. But what we have here is an oligopoly entrenched on Wall Street in the City of London who are artificially keeping the price of interest rates low to make it easier for them to speculate, which has another deleterious effect because those who are wishing to save are pushed into having to speculate to try to get returns above that 0 to 1%. So they are, in fact, it's kind of like a drug dealer trying to recruit more heroin addicts by keeping those rates artificially low. It's vice. This is a question of vice, Reverend. Now, wouldn't you agree that this is pure vice?
Max, I think your analysis is sound here. There is a notion that it's the market that sets interest rates, but in truth, for 20 years now, we've had a frenzy of debt. We've had an explosion of indebtedness by households, by companies, and by governments that's been systematically engineered by governments, central banks and banks, that's been at the heart of this global trade imbalance between East and West. And what's more, when we indulged in this frenzy of indebtedness, we didn't use the money that we were borrowing for new vital economic resources to build for the future. A great deal of it went on consumer items which won't last very long. So there is a macroeconomic picture in all this which is vital to us. If governments and banks are going to be steering the market, then they need to recognise that over half the adult population of Great Britain feel that savers are neglected in all this. And so we want to see the interest rates put right for the benefit of savers. It's interesting that you should mention Keynes and the paradox of thrift. Our movement, and the website is at saveoursavers.co.uk, is not primarily about economic theory, but there is a myth abroad that the Keynesian message is about not doing any saving at all. And that myth needs to be exploded. Saving by households, by individuals for the future is always a good thing for it's part of our faith in the future that we encourage families and households to treasure. And whilst there may well be complex macroeconomic decisions to be taken at particular times, the long-term future of saving and of savers needs to be much higher in the attention of policymakers. And we're particularly concerned, not so much for the, let's call them the very wealthy, successful savers. We salute them, they're important. But there's a second category of saver, the struggling saver, the families who are struggling hard to build a pension pot for their own future, the pensioners perhaps who can no longer work but who need the interest from their savings to supplement a quite small pension. Max, they are suffering at the moment.
You can't have capitalism without capital, and you can't have capital without savings. And, of course, in a twin attack against savers, of course, you also find people attacking wage earners, especially in the United States, where unions are looked down upon as being something anathema to the American economy, even though without wages being properly set to reflect true supply and demand curves, you don't have savings and you don't have capital, and you won't have capitalism. And as a result, America has morphed into this quasi-socialist states where the banks get bailed out every time they make a mistake, and everyone else has to subsidize and underwrite the bank's failure. And it's a kakistocracy where you have the rule of the least qualified in America. It's no longer a democracy. Now, personal debt in the UK exceeds GDP. Doesn't this give debtors far more leverage over policy?
Debt is very high, but we need to remember that people in debt, people who hold mortgages, are also savers too. It's true that there are 10% of households in the UK for whom their total liabilities exceed every asset that they possess. And it's important in a caring, civilised society that those who have look after those who haven't.
But Reverend, you're treading a very dangerous line there by suggesting that home equity is the same as savings, because what we learned in the last 2 years is that that's false, and that home equity is not savings when the home prices are being manipulated by the speculators. So I think I'd have to disagree with you there.
Max, you make a very good point there, but the point I want to make is that debtors are also savers at the same time, not in respect of these very high levels of debt that they've got, but they will also be struggling to save for the future by other means too. There are the number of savers in the UK, the number of people regularly putting money away for the future, teenager is 26 million. That's over half the adult population. Now, many of them, too, will hold mortgages and debts, but they remain savers. But where you're right in your analysis, if I can just finish, where you are right in your analysis is that the policymakers are focusing on helping the indebted and not giving enough attention to the saving.
Right. The only way
The
only way debt would equal savings is in an inflationary environment. So at the top of the interview, you're saying you're against inflation. So you have to decide whether you're for inflation or against deflation. But let's move on. The UK government is responding to the financial crisis caused by too much debt with all sorts of incentives to encourage citizens to acquire even more debt. Your thoughts?
What we want to do, as far as inflation is concerned, is to bring a halt to the disguising of the level of inflation insofar as savers are concerned. We want policymakers to acknowledge the real impact of inflation. We have in the UK a whole series of devices and measuring instruments for inflation, and shall we say some of them fit a little bit too closely with government's intention to maintain that inflation is very low.
On this we can agree because the government statistics on GDP and inflation and CPI and the PPI are cooked in the government's favor, and the government is unabashedly in the pocket of the speculators. So before we can really talk about inflation, I agree, you really have to decide what terms we're talking about and whether there's any integrity in those statistics and terms, and there really is none as far as the government is concerned. But we're going to have to end it there, Reverend. Thank you so much for being on the Keiser Report.
Max, thank you very much for bringing me onto the program.
And that's going to do it for this episode of the Keiser Report. I want to thank my guests, Stacy Herbert and Reverend John Strain. If you'd like to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.